Okay. Good morning, everybody. Thank you for showing up today to the next webinar series. Today, we're going to do a deep dive into debt, the fixed versus floating, banks versus debt funds, when it all blows up. We think debt is one of the most overlooked risks in real estate. And it's not always the real estate that's the issue or the building itself. It's frequently the debt and a lack of alignment between that and the properties themselves.
Yeah, so with that, I'll give you guys a quick background on the firm. So the firm, Hanson Capital, got started back in 2008 with a heavy focus in the residential space. Chris Hansen was buying single family homes at auctions and packaging them into portfolios that he eventually sold to institutions, as well as started a service business where he's buying homes on behalf of institutions. Shortly thereafter, transitioned into the apartment space, doing a lot of existing value add acquisitions and executing on those acquisitions and recycling the capital. Few thousand doors bought and sold between single family homes and apartment doors across the Sun Belt. We didn't start buying industrial assets until 2018 and then picked up a lot of speed 2020, 2021. Today, going forward, we still are very heavily focused in the industrial space, and the niche that we're focused on today is small bay multi-tenant business parks. And currently, we have about 350 million of assets under management between our debt platform and our equity platform, with 1.6 million square feet of assets under management on the equity side of the business. With that, I'll kick it off to Ted to give you a quick disclaimer and kick it off.
Thanks, Mike. So before we begin, the information shared today is for educational purposes only and does not constitute an offer to sell securities or a solicitation to invest. Any potential returns discussed are not guaranteed and depend on the company's ability to execute its strategy as outlined in the private placement memo. So please conduct your own due diligence before making any investment decisions. Also, we find these webinars are best when there's participation. So if you have any questions, please feel free to enter them into the chat. We'll get to them as we can, but we find that oftentimes the best kind of dialogue we have back and forth is when we get audience participation and questions. So feel free to ask any questions and we'll answer them. So first, we're going to kind of look at the lending landscape. We're going to break down the debt side of real estate in plain English, walk through who actually lends on commercial real estate deals and why it matters which lenders you choose. We'll look at banks, credit unions, life insurance companies, agencies, debt funds, and private bridge lenders, as not all capital is created equal, and the lender you choose shapes your risk, your flexibility, and your exit options. So Hanson, first, can you walk us through the lending landscape a little bit and who are the main players and what makes each one different?
Yeah. So as Ted outlined here, we've got these six main broad categories of lenders. There are more than this, but I think this is the main buckets. Your banks is going to be your traditional, Wells Fargo, Chase, the large banks. Credit unions are going to be your more smaller, local, regional sometimes that operate a little bit more relationship focused. Life companies is going to be the big insurance companies of the world. A lot of people don't know this, but they are usually some of the biggest lenders in the world. They take the policy premiums that get paid and then they deploy those out to build a return on it. In the lending space, that is usually the cheapest source of money out there. It's oftentimes for trophy or fully stabilized assets. We don't use those in value add, or it's not our first lender, but it's usually our permanent lender. Agencies is a big one. Fannie Mae, Freddie Mac, a lot of people have probably heard of those. They only lend on apartments, but they're kind of known for being also really well priced, higher leverage than typical, but kind of government affiliation, which has them being ultra competitive, and they are part of what props up the market in the multifamily arena. And then these last two, debt funds and private or bridge lenders, are similar on the surface, but they're used very differently for very unique purposes when we dive deeper into it. A debt fund is going to be, it could also be like an insurance company that has like a higher risk pool where it's a higher rate, but it's going to have a lot less hoops to jump through and will be easier to obtain than a traditional bank, but it's not going to be full asset lending like a private or a bridge lender. So think if we did a 2 or 3 year execution, as we often do, and if we didn't have the strong bank relationships we do, a lot of sponsors will use a debt fund. Think rates in the 7, 8, 9 today, as opposed to banks in the 5, 6, 7. And then the private bridge guys probably 10, 11, 12. So they operate very differently. But those private lenders at the end of the scale, which is another business we've been in since 2009, we think that has a time and a place. And it's somewhere we love to keep our capital, collecting 10, 11, 12%, but it's not something we're generally borrows or on the borrower side of. So we think choosing the right lender is as important, if not more important, than choosing the right building.
So Pike, when would you choose one over another?
Yeah, I feel like Hanson did a good job covering this high level, but to dive into it in more detail, it's going to be dependent on your business plan, heavily dependent on business plan and timelines. And flexibility requirements. The easy example of it is for like banks versus life companies. Life companies are going to be one of your cheapest options out there in today's environment, specifically in the industrial space, in terms of overall, all-in rate perspective. But they have restrictions around flexibility, such as yield maintenance provisions, where you're essentially going to, no matter if you want to sell the asset at any point in the term of the loan, say you've got a 5-year loan and you want to sell the asset in year 3, you're going to have to cover the interest payments that still remain between years 3 and year 5, and that can be detrimental to your sale decision or your proceeds that you receive at the sale. Versus a bank, they might be a little bit higher interest rate, but they tend to give you a little bit more flexibility in terms of prepayment, where maybe you're just paying a flat rate fee of 1% when you go to sell an asset, regardless of when you sell it, things like that, right? So flexibility within your business plan will a lot of times dictate which option you want to move forward with. If you're planning on holding an asset long term and have no intentions to sell and you want the cheapest rate, then you may want to go towards the life company route or the agency route if you're in the multifamily space. Or, if it's a scenario where, say, you're very confident in your execution, where you have a tenant in tow on a development and you simply need some short-term financing and you want to maximize your leverage and you feel confident in your execution, you may look at, debt fund or private bridge lending in order to really juice your returns or your multiples, because you're extremely confident in your execution or your exit, right? And some people are willing to take that higher rate in order to really improve those multiples if they feel like the risk reward profile is acceptable for that scenario. So that's, it kind of jumped all over the board there, but hopefully that covers it a little bit for you.
Yeah, absolutely. We did have a question come in from Tyler. What range of rates would you see from life companies compared to banks?
Yeah, that's a great question. So I would say today, and this range is all over the place over the years, right? And we'll get into the indexes that these are tied to later, but typically a spread and I'll give it across all of these. We have an index which is either off of treasuries or SOFR, in certain cases, Wall Street Journal Prime, but let's just say off treasuries. The 10-year treasury is something that people talk about and most people are most familiar with. Today, the 10-year treasury is like high 4.6s. Our life codes are going to probably be 125 basis points of spread to 150 basis points of spread. And a basis point is 1/100%. So 100 basis points is 1% of interest rate. So these guys, they're living off that spread between the index and what they can extend the rate at. So if a life code gets 125 over, that's going to be the most competitive. I don't see banks dropping under 150 very often. Much more traditionally, they're going to be 175 to 250 if they can get it. That is pretty standard. Agencies are also going to be kind of in the low to mid 100s. But when I say that, that's going to be the government pricing those through Fannie and Freddie. And what's often misunderstood with lending is when you hear rates have gone up and the federal funds rate, right? The overnight lending rate between financial institutions has no bearing at all on our interest rates as a borrower. That's more, I'll say, higher up the funnel for banking. What changes and affects pricing, like right now, mortgage pricing for people on their single family homes is rising rapidly. Well, the underlying reason is the treasuries have been going up and the banks need to maintain their spread. So spreads are more important than necessarily rates, and the agencies will expand or contract their spreads to kind of keep the pricing where they want it. So when there's more uncertainty or volatility in the market, you're going to see spreads widen, meaning they want to be paid a bigger premium for extending credit. And when things are more stable, you get banks kind of competing to undercut each other, and that's when those spreads tighten. I know that's a lot. We could talk about this all day, but I want to try and keep it high level. So agencies or life insurance is at the bottom of the bucket, and that's somewhere around the 125 basis point spread.
And the only thing I'll add to that too, similar for risk adjusted returns, these lenders are looking at slightly wider, like that range he's giving you is dependent on what kind of leverage you're putting on to the deal and what kind of product type. Like these lenders may have
Very true.
specific product types that they're in favor of. Like example, industrial spreads are much tighter than office spreads. And then if you're doing a 40% leverage deal or 40% LTV loan versus a 65% LTV loan, they'll give you a much tighter spread for the lower LTV loan. So again, that's why he's kind of talking in ranges, and that's why you have to give those ranges, because it's dependent on asset class and leverage.
And that concept is critical because that is lending. From the bank side of the table, they're giving us money or other real estate investors money to go, be a secured, their upside is limited. Their downside is not, because if you screw the thing up, they don't want to own the asset. So that spread they're living on is against the treasury rate, or AKA the risk-free rate. So if they could take their deposits and put in treasuries at 4, but they're willing to lend to us at 5.5 and take 150 basis point premium, that is the banking business. They're trying to manage that spread against what Chris Pike just mentioned. A 40% leverage loan is very different than an 80% leverage loan. And that's why it's priced differently. So back to when I said the debt funds and private lenders are going to be more expensive, they're going to give you more leverage, and they want to be rewarded for taking that risk.
Actually, a good segue into one thing we want to talk about. Can you talk about relationship lending, Hanson, and what it means in practice and how it really moves the needle for us here?
Yeah. Relationship lending is just a phrase of, if you know the guys on the other side of the table, you tend to do more business with them. You might get better terms. It's no secret that I came from a banking background. I think it's been a huge differentiator for us that, as we're explaining to you guys today how the banking side of the table works, if you can show up as a borrower and talk to your lender with intelligence around the risk that they're taking, and, oftentimes we are stress testing or running different scenarios of what could happen. And a lot of guys get stuck focusing on all the good things that can happen. We focus on the downside. We focus on where the risks are. And when you're sending your underwriting model to a bank and saying, hey, here's what we're underwriting, and they look through and go, okay, he's underwriting rents to this. Is that reasonable or not? Because that's their job. Poke holes in it, find the problem in your business plan. If you're consistently being conservative and realistic with the underwriting you provide, that helps build the relationship with the lender, as opposed to think of the converse of that. If the market says rent should be $1.50 and you send the bank an underwrite saying the rents should be $2, and they have to call and say, hey, we think you're crazy. You're 35% above market here. Why? And that's a fight on every single thing. That doesn't build a good relationship. And that's above and beyond the basics of, do you make your loan payments on time? Do the deals you do hit and perform at what you execute? Our primary bank, which it's not, I say they're our partner because they really are. They put more money into the deal than myself and everybody else combined, because we don't ever really do less than 55, maybe 60% leverage. First Bank has been a partner who has been so critical in our outcomes, and they will oftentimes outprice or charge us a smaller spread, or compete with much larger banks or even life cos in certain scenarios. But where it moves the needle, these relationships, is the bank has to have confidence in your execution ability. And recently, on a deal that we're underwriting right now that I think hasn't quite come out, or it will be next week, a Scottsdale deal, we had 8 different lenders involved, and our bank was not the primary lender, but we got on the phone and kind of pleaded our case, and we're transparent with, hey, here's where the other competitors are in the marketplace. Do you want the business, or do you want us to go somewhere else? And there's a very respectful way to do that. And I think we can pride ourselves on doing that because they match the pricing. Um, and then the other banks want to tighten their spreads further, and we just say, hey, that's not how it works. We gave you a best shot. Our bank matched it. So it's really respecting that relationship for what it is, your critical partner in doing deals. And one last thing on that I'll mention. I've been in Las Vegas until last night at a national real estate conference called ICSC since Sunday. And all the banks, brokerages, everybody has big booths and these fancy dinners. And I was with a number of bankers, but the first bank guys were talking about our acquisition team is running debt service coverage ratio stress tests on every year through our hold period at a whole range of different underwritten rents, like today's rent, but then also much lower than that to see, hey, if things got ugly, what would this look like? And I overheard their conversation and chimed in and said, how many other customers do you have that do that? And they said none. So our bank was bragging to another bank at dinner about us, unbeknownst to me, saying, hey, this is how our customer is underwriting deals. That's a relationship lending example of we're going to get the right terms because the bank is impressed with how we go about it, not, hey, these guys don't know what they're doing. Let's raise their raise their price or lower their leverage.
We're going to move along to the next topic. So fixed versus floating. There's obviously scenarios where you'd use one versus the other. Can you kind of break down, where that comes into play, Hanson, and when does each one make sense?
Yeah, this one's a common misconception. I think everything should generally be done with fixed rate. Uh, a fixed rate loan locks us in against future rate increases, and depending on terms, there's great opportunity to refi into a lower rate. We really saw guys get killed in the 22 kind of rate height cycle. Whereas floating, as Chris Pike was mentioning earlier, when there's certainty of execution, and I'll say that's pretty limited in the stuff we're doing, and it's more common in like retail development. But if you have Starbucks as a customer and you're going to go build 100 stores for them this year, you might not want to go raise all that money from limited partners. You might want to figure out how to capitalize that yourself. And you might use a floating rate loan because you've got 10 months of total construction time and it's going to be sold, upon getting a C of O. So there's very certain scenarios where floating rate makes a lot of sense and you want to run a lot higher leverage and you're not necessarily worried about rate fluctuation, at least in the short term. And there's ways to mitigate that by buying an insurance policy and things like that. But the fixed versus floating really comes down to I'll say safety or risk avoidance. Pike, do you have anything you want to add to that?
No, I think you nailed it. I really don't have anything I could add. I think you did a great job covering it all.
Okay.
Cool. Pike, what's more important than the interest rate itself when you're looking at a loan?
Yeah, from a risk perspective, two key items to pay attention to from this slide are both like term and covenants, right? Making sure the term of your loan is in alignment with the execution of your business plan. Say you have a weighted average lease term on your industrial business park that is 5 years, but you only have a 3-year term note, like three years of term on your note. That mismatching alignment can get you in trouble. So paying attention to the term. Also, another way to look at it is if you look back at what happened in 21 and 22 with apartment deals, a lot of times, people had 3 or even 5-year term loans, but with the huge shift in interest rates, when those terms are coming due, it creates issues for borrowers that were once borrowing at 3% at higher, 3.5%, 4% at higher leverage, and then having to refi in an environment where you're looking at note rates in the 5.5 to 6.5% range, depending on the deal. So paying attention to your term and making sure it aligns with your business plan and what macroeconomic expectations or outlooks may look like in the future. Also paying attention to covenants, right? You want to make sure you're not tripping any sort of covenants within your lending documents, right? So your lender is going to test your loan at any given point throughout the hold period, and those testing timelines will vary, but typically they're doing it at least on an annual basis, depending on your lender. And if for any reason you're tripping those debt covenants, they can call your note due or they can make you right size your loan. So paying attention to what the debt covenants are and ensuring you're not going to trip any of those covenants are two key terms that you need to pay attention to while, from a risk perspective. I hit it earlier as well. So another important thing outside of risk is, your prepayment penalty, right? Making sure that also aligns with your business plan. If you're planning to sell in year 3 and you have a huge prepayment penalty for selling before the end of a 5-year term, that's not going to end up good for you. It's going to be detrimental to your proceeds at sale. So paying attention to prepayments is also a big issue alongside paying attention to rate and the other ones I mentioned.
Pike, you brought up covenants 17 times. I don't know what that word is. Some of our customers or audience might not know either. Can you give us an example of what some covenants are?
Yeah, sorry, hit it too high level. The covenants that are most common in loan docs is your debt service coverage ratio. And all that is does your net operating income service or cover your debt payments at a certain ratio? And typically you're looking at a 1.25 ratio. So say your debt payment is $100,000 a year, they're going to want to make sure that your asset is delivering at least 125,000 a year in NOI or greater. So you're not below that 1.25 debt service coverage ratio. The other one that they look at is debt yield. And that's the, similar concept of where you look at your NOI and compare it to your total loan balance. And debt yield requirements have shifted over time within the market, but today most lenders are looking for debt yield somewhere, at least in the industrial space, somewhere around 8 or 9% on a debt yield requirement.
Another one might be occupancy. So, and a lot of these go hand in hand, right? So you might have an 80% occupancy covenant, meaning they want to always be able to say, if the property's under 80%, we get to kind of review the loan. And that's a scary thing if you are in a tough time and you see occupancy start to dwindle. I'll say, for example, right now we're seeing this in multifamily as rental rates have come down, rents are going down. One way people try and combat that is they'll rents go down, which is going to blow their debt coverage ratio or their debt yield. So they'll try and offer like 2 months free or 3 months of free rent to keep that rate up. Because if they drop the rate to $800 a month on an apartment instead of maintaining it $1,000 a month, they'd rather concede or give away free rent to keep that number up, because what they're trying to do is avoid blowing a debt covenant. And as Pike mentioned, if you blow those, they will right size the loan, meaning, hey, you owe us 20 million bucks as your loan principal balance, but because you're blowing all these covenants, we want you to make a $5 million pay down on the loan. Otherwise, we're going to make it due. Blowing these covenants are things that guys don't really necessarily think about. They were in compliance with them when they took the loan, or they wouldn't have got the loan. But it's very easy to fall out by kind of not mapping your start to finish of your business plan, especially on value add stuff, where maybe the plan involves vacating a bunch of the units and blowing occupancy covenants. So these are things you want to negotiate up front, especially when you're using, a real bank as opposed to a bridge lender. Private lenders and bridge lenders don't care. If you're going to buy a $20 million building, they'll give you 10 million, maybe 15 million all day and hope you screw it up. The real bank that gives you 15 million, they want to make sure you're going to meet all these covenants the whole way through so that they can answer to the regulators on their side.
Nancy, can you talk about like recourse versus non-recourse and what LP should understand about personal guarantees?
Sure. Those terms are pretty obvious, I think. Recourse meaning if I borrow the money, let's say in that example, we buy a $20 million building, we borrow $15 million. Part of the way I get the normal banks to work with us is a normal bank will usually give us a better rate if I provide a guarantee. So I'll put a personal guarantee behind the deals we do. And that's probably been the case on 60 to 75% of the deals. When we can get them without hurting the terms, there's no reason to offer it, right? That's an extra chip or guarantee from myself to put on the table or the sponsors involved. And there's good reason to not want to have recourse. Whereas the non-recourse loans, I think it's kind of a misconception. People get really excited to say, hey, look, I've got non-recourse debt. But what they fail to understand is Most loans, if not all loans that I've ever seen, have what they call springing recourse, or recourse that ends up being recourse even if you took out non-recourse. An example of this would be on the last apartment community we developed. We built it in Dallas, and it was a non-recourse debt, like a $40 million project, 30 million of debt, and it's non-recourse. Well, there's a completion guarantee. So when you go through a uncertain time like we did the last 4 or 5 years, that non-recourse loan isn't truly non-recourse until you finish the project and get your C of O and C of O, certificate of occupancy. So it's very common where even in a non-recourse scenario, you need to be able to execute the business plan. My personal methodology on that is if I don't have enough confidence to sign a guarantee, I shouldn't be doing the deal. It just, if I don't have real good confidence we're going to do it and I'm not willing to put my guarantee behind it, then why are we doing it? That's more like gambling, and that's not the way we approach it.
How about amortization versus interest only, and how does that decision impact cash flow and risk?
Yeah, I can jump in there
Yeah,
if you'd
Mike,
like,
go for
Hanson. Yeah, the amortization versus interest only is just whether or not you're paying down principal balance within your AM schedule on a note. In interest only loans, you're simply paying the interest payment only and no pay down of the principal balance. So your all-in payment on a monthly basis is lower and will improve cash flow. And a lot of times lenders will implement an interest only period when you're buying a value add profile deal, and cash flow going in is going to be limited because you're dealing with turnover, or you're doing with, because you're executing a lot of capital improvements and pushing rents to market rates. They understand that, cash flow is going to be limited over that time frame. So they'll give you an interest only period to help handle those cash flow issues while you work through execution of the business plan. And then they'll shift into an amortizing note where you start paying, chunking away at principal, where your overall loan payment on a monthly basis increases overall, but it's still beneficial to you as the owner or the sponsor in the deal, because you are chunking down slowly portions of the principal balance. So even though it's not cash flow that's distributable to you and your partners, it is helping your overall position in the asset by lowering your principal balance on the loan. So, there's positives and benefits to both scenarios, but a lot of times interest only loans are implemented during the execution of a business plan that requires, or that you're going to see lower amounts of cash flow on the front end.
And let's take that back to the lender side of the table again, right? When we do our hard money loans, those are always interest only. And we want to be really confident our loan amount will be safe over the whole duration of that loan. From the bank's perspective, as soon as you're making those principal payments every month through an amortized payment, you're reducing their risk every month and every year. And as Chris mentioned, sometimes people don't like that it eats into the cash flow, but I view the amortization pay down as the same kind of income as the cash flow. We just can't spend it the same way, but paying our loan down every month is phenomenal. And with time, we can draw that equity as appropriate. But I think the reason we get it on the deals where we're doing value add is not just so we can weather the cash flow of doing that. That's like a bonus that the bank is giving you, because traditional banks do not like to give interest only payments. They want you to be amortizing the whole time. And, we used to push for 6 months or a year on shorter business plans. Now, we'll push for 2 or 3 years when it makes sense.
Can you give us a real life example where choosing the wrong loan structure created a problem, even though the building performed, Hanson?
Yeah. The most recent one is we have an apartment building. The last apartment acquisition we actually made, we bought in January of 22. We did everything right on this property, from the sense of when we bought it, it was off market. The value add story worked. We used a bridge lender. In multifamily specifically, you pretty much have to use a bridge lender, and then you go to agency, because agency lenders won't work until you've stabilized the property. So everybody takes those, and they're always going to be floating rate. And then what we did in that scenario was we bought an interest rate cap policy, which allowed us to hedge in case rates jumped. But closing January 22, the month before we started the largest interest rate hike in history, it helped in that interest rate policy. Our loan payment tripled over the course of the next, like, probably 18 months. The loan itself wasn't necessarily the problem. And as we executed the plan, the lender ended up saying, "Hey, we're not seeing our other loans perform. How are you guys doing on it?" And we were constantly assessing our rents. And we realized that as that got to be a scary time, we weren't getting the return premium we were expecting for renovating the units. So we paused the renovation. I think we only got through about half of the units. On an apartment building with 12-month leases, as you work through them, you can only do so many at a time, and you wouldn't want to empty it and do them all at one time. It ended up in a situation where when it was time to pay off that bridge lender, the new underwriting at the higher interest rates wouldn't support the loan amount that was in place. So we had to do, instead of a cash out refi, we had to do what's called a cash in refi, meaning we had to bring more money, additional capital at the closing table to get out of that bridge loan and get it into a Fannie Mae loan. That wasn't necessarily the loan structure creating the problem. That was us using every available tool and the kind of justification for why you need to have that interest rate policy. If we didn't have that interest rate cap policy, we would have lost the asset, and it would have been a complete failure. And the building itself today is performing, it's 100% occupied as of into Q1. That's rare. Mid 90s is the target. But we're still in a situation where the cash flow, even with the debt that we were able to get from agency or the best financing available, is not an ideal outcome for us. So that was just structurally, even when you do everything right, the result isn't what we want. With the benefit of hindsight, there isn't anything we would have done different. It's just an outcome that doesn't match what we expected or wanted.
Makes sense. So how debt breaks deals, Pike, maybe could you talk to us a little bit about maturity risk, what it means, and why it is the number one way that debt will kill deals?
Yeah, so I touched on this very briefly in an earlier slide, but maturity risk is just making sure the term of your loan or the timeline before your loan matures is in alignment with your business plan, right? So as it relates to a lot of the deals that we're doing today on the small bay multi-tenant industrial business parks, you're looking at weighted average lease terms, and typically they're in the 2 to 3, sometimes pushing into 4 years of weighted average lease term. And if your in-place rents are well below market, and as you're working through your business plan, towards the end of your business plan, you need to be able to execute all those mark-to-market rents or pushing those rents to market rates in order to successfully execute your business plan and your exit or a refinance down the line. You want to make sure that the term of your note allows you not only the time to get through your lease terms, but also give you some flexibility if things don't go exactly as planned. So let's say, hey, you have a 3-year weighted average lease term. You do not want to get a 3-year note or 3-year term on your note, because when your note matures, you're running into an issue where a significant amount of your rent roll could be vacant because of all the turn in your rent roll. And I'm using very specific terms here, but essentially, if you have a large portion of your rent roll that has leases expiring near the maturity of your loan that's in place, you're setting yourself up for failure, because there's a chance, not saying it's going to happen, but there is a chance that you're experiencing a large amount of vacancy when your loan matures. And when you go to execute a refinance, you're going to be in a tough position because of the fact that your revenue is severely compressed due to all the vacancy in your rent roll. So you want to make sure that not only does the term of your loan align with your business plan, but also gives you some sort of buffer. So you've got maybe a 3-year weighted average lease term. You want to go get a note or a loan with a 5-year term to give you some time to work through any sort of turnover that's occurring alongside getting that turnover leased back up. So if you have a good chunk of tenants that leave at the end of their lease terms, you have sufficient time to execute your improvements and then go and replace them. So when you don't plan for that accordingly, it can blow up your deal pretty quickly and limit your options from a refinance standpoint, and then you're forced to sell at an inopportune time as well.
Can we talk a little bit about floating rate exposure and what happened to sponsors who didn't hedge on their cap rates, Hanson?
Yeah, that's a great example of what I just spoke about. So that interest rate cap policy on that example, that last multifamily deal that we had acquired, I'll say, so we paid 14 million for that deal, and I think we borrowed 12 with our bridge lender. Sorry, 11 with our bridge lender. The policy for that was like 3%. So I mean it was 350 grand, something like that for a 2-year insurance policy. A lot of guys didn't want to spend the money for that. And when that rate went from, somewhere around 4% to 9.5%, the debt payment, nearly tripling a debt payment, that policy was paying out like $45,000-$50,000 a month. So the guys that skipped those just got absolutely slaughtered when the interest rate moved. And to be fair, we hadn't seen expensive debt really since the 2008 crisis. Like interest rates had been near zero or low for so long. When we were doing those deals before the rates had started to spike, especially on the tail of COVID and all the free money, it wasn't really something where people were going, hey, I bet rates are going to, go up 3 or 4% in the next 12 months because it just hadn't happened. That being said, it takes the discipline to say, hey, we're taking a floating rate here. We're taking variable rate risk. And the prudent thing to do is hedge against that. It hurts. It's painful to write the check, but there's a lot of people who lost a lot of buildings and equity along with it that didn't make those decisions.
So Mike, a little bit more about covenants and how they work in practice. What does it actually look like when it happens, when covenants get triggered?
Yeah, I think this question specifically ties back well to what Hanson covered on relationship lending, because what happens is drastically different depending on the lender that you utilize, right? Like a life company or an agency is likely going to be much less flexible with you when a loan covenant is triggered than a regional bank that you have a strong relationship with, right? So what happens is it varies, right? If you've got a regional bank that you're working with and have a strong relationship with, they'll tend to, again, they aren't in the business of taking the asset back and owning and managing and operating assets. So they typically prefer to work with you as the borrower or the sponsor in order to find a path forward in order to avoid them having to call the note due or taking over the asset versus an agency or a life company or specifically a bridge lender. Sometimes bridge lenders, that's their whole game plan. Like they want to lend at, higher leverage and more aggressive rates with the concept of they hope you might mess it up and they get the opportunity to take your asset at a discounted basis, right? So, it all depends on who your lender is and how aggressive they want to be when those covenants are triggered. But most of the time, I guess the piece that I talked on, hey, a lot of times your lender will work with you. If they don't want to work with you, the opposite end of that scale, I guess, would be, hey, you've got to right size your loan so you're no longer triggering those covenants. So you got to, as Hanson mentioned earlier in the example, instead of your $20 million principal balance, you got to reduce it to $15 million in order to avoid tripping those covenants any further. Or they could, at the end of the day, call your note due and put you in a position where you're forced to sell, or they take your asset through foreclosure.
We have an audience question. What did the last rate cycle teach the industry about debt discipline?
I'll take that. I think there's a lot of lessons that took, and I don't know if that's coming from the lender side of the table or the borrower side of the table, but I think it's worth noting that Arizona is a very lender-friendly state. So, and Texas is too, most of the states we operate are that way. California is not. We're not active there. That's one of the many reasons. The rate cycle moving as quick as it did, as we talked about the floating rate exposure, it should have taught people if they're going to use variable debt, they should use that. But I think the bigger things that came out of that was the banks have their own churn and turnover of executives. So the senior bankers have been there for 40 years. They've seen these cycles. There's a lot of lenders that have required caps where you used to be able to say, I will or I won't. Now a lender won't allow you to choose to not take a cap because the lenders got their ass kicked through that process as well. And I think it's led to a lot more discipline. Like we typically do deals at 55 or 60% leverage. And that is the lowest it's been in my career. I've been doing this 20 years. And, we used to be borrowing 70 or 75 when the banks would offer us 80. Now we're 55 or 60, and the banks would probably cap us at 65 or 70. So the discipline that's been taken from this last cycle, I think, is applied across the board. There's always going to be the guys that are going to maximize the leverage every chance they get. And if you're purely return focused, that I can't argue that move. But I think as soon as you factor in the risk reward side of it, we've been pretty thankful that we've taken our leverage down since that last, rate cycle.
What's the difference between a sponsor who plans for maturity and one who hopes for favorable conditions?
Planning for maturity is, having that business plan mapped out from start to finish on the way in. A lot of people would focus on getting the loan as opposed to knowing how they're going to get out of the loan. Like if you dumb it down to be super simple, if you're going to fix and flip a house, the focus should not be on getting the lender to give you money to buy the house that needs a bunch of work. The focus should be on the market for selling that house when you're done doing the work. And, we saw this going into the GFC or the 2008 crisis. I remember being in the mortgage banking industry, and there were borrowers that were not worried about the negative amortization loans or the option arm loans because they would rent a house out for $2,000 a month, even though the interest only payment was $3,000 a month, because they were saying, oh, it's going up so much in value. It doesn't matter that I'm losing money every month I own it. And that's somebody who's hoping for favorable conditions as opposed to somebody who's planning for their exit. So we don't go into anything without having not only our plan mapped out, but also plan B, plan C, hey, if this were to happen, what do we do? Just conservatism.
Got it. So how do you plan, how do you build a refi plan before you even close the acquisition?
Yeah, so I can take that one. A lot of it is just through stress testing assumptions, both on your refinance as well as on your business plan. For an example, you look at it from a basis of, okay, we know these rents are achievable in today's market. Well, what happens if rents pull back 10 or 20%, right? And if those rents pull back 10 or 20%, what kind of debt service coverage ratio are we hitting when that happens? Are we tripping any of our loan covenants? Are we able to actually refi, 5 years from now when our loan is maturing with rents pulling back? The other way you can stress it is looking at it from a perspective of, okay, you can still stress those rents. Well, what happens if interest rates go up 100 basis points? Or 150 basis points, 200 basis points, whatever the case may be, however far you want to stretch it. That's how you can start testing of, okay, if rents pulled back 20%, our, interest rates went up, 100 basis points at the end of year 5, what does our model look like? And are we successfully able to refinance our principal balance without having to call in additional capital when that time comes? And that's how you can plan for your exit, right? And sometimes even, again, a lot of people you can stress that. And when the market moves fast enough, like it did in 21 and 22, having rates double, like sometimes people even stressing didn't cover that, right? So like, no matter how hard you plan for your refis, sometimes the market moves so quickly where you can't cover that, but at least, giving yourself a shot to what's realistic or potential to happen in the near term. And is there a way to get out of a situation if things don't go as planned? Not just planning for the best outcome or focusing on the upside. That's where it's focusing on the downside and making sure you have an exit plan when that time comes if things don't go so as planned.
We had another audience question. How do you assess and pick a choice or type of lender in general with all the options?
I'll take that one. So of those 6 broad categories we spoke about, I think experience, you could go apply to 6 different types of lenders on a deal and you'd find out pretty quickly which ones are not, but just simply experience of taking the business plan of what you want to do and not making the mistake of, who's going to give you a loan. Who's going to give you a loan is letting the banks kind of do the work for you. But one of the tools we do when they're close, like to use that comparison we said of like the life companies versus the banks, or even sometimes credit unions will get really aggressive in the market they want to be in. The lenders on their side of the table have an allocation that they want to deploy X amount of dollars, and they're going to balance that across asset type. They're going to balance it across geography. So there are outliers, which is why we'll shop multiple types. But the business plan we're going to do should be dictating the type of debt we do. But that example I used where we called our primary bank and they stepped up a lot. They give us a 50 basis point reduction in rate. That situation, we had life cos, we had some bridge lenders, we had a few different types in the mix. And what we do is we build an underwriting model that can run in different kind of column sectors, all the different scenarios. So we create a matrix, and we had 8 different lenders in that particular one, where it's very easy to look at, because as we've talked about a lot on this call, the interest rate is not always the best component. And when we start factoring in what our exit timing is and what we think it's going to take in terms of executing the business plan, it will then become more clear. And in the scenario where we're talking about where we got our bank to step up, we were in a situation where, we had recourse as a factor. Life cos are generally non-recourse, and the banks are going to be recourse. So we had to decide and assign a premium that it was worth to take recourse and have the flexibility, because the big downside to the life cos is you're not going to have much flexibility. They're going to have full yield maintenance. So you've got to get the term of that loan to align. You layer all these factors in here. And I'll go back to the initial answer that was a lot less wordy. The deal is going to dictate the type of lender, but still shop it to other lenders to make sure there isn't somebody who's just underweight on that particular asset type who's going to get a lot more aggressive.
Like, why do you prioritize flexibility over lowest rate? And can you give one specific example?
Yeah, it's very easy example of that is, hey, we've got a business plan that we're looking to execute in 2 years, and we're going to maximize our value or our IRR through a shorter term execution. And we need some flexibility on when we can sell this thing without being penalized, right? And it goes back to what Hanson just mentioned on, a life company versus a bank loan. Life company might save us, 50 or 75 basis points on a rate if we go with them. But if they have yield maintenance through year 5 of the loan, and we're planning to sell at the end of year 2, that 75 basis points of spread or benefit from a lower interest rate dissipates pretty quickly based on the penalty that we're having to pay for selling the asset in year 2 and having to pay that yield maintenance, versus the bank. Maybe the bank says, hey, we'll give you a little bit higher rate, but we won't charge you any sort of fee at your exit unless you refinance with someone else. So you have no prepayment penalty. That in the short term can save you a lot of money if you're planning to sell in short term. So and again, whether it's planned or not, if you want to have the option to sell at some point, sometimes it's worth taking the lower rate for that flexibility. And that's probably the easiest example I could give you.
Yeah, and I'll give you real examples, Pike. You probably remember on 16th or 29th Drive, we paid $16 million for a building. We spent the first 18 months, we bought it in mid 22. We spent 18 months kind of stabilizing it. We put a Mutual of Omaha permanent loan on it. And in that, we had 3 years of full yield maintenance. I think we had a 2-year lockout. And then through year 3, it was yield maintenance. It wasn't 6 months after we took that loan, we had somebody show up, offer us $26 million for the building. And we hadn't put hardly any money into it. It would have been a huge win for us. We didn't sell it, but had we ran through the math, and we did, that lockout period would have kept us from even closing. But the yield maintenance, I mean, it would have been millions of dollars that we would have foregone in that. And what we learned from that scenario, and we knew, but we've put it in practice otherwise, it's part of why we prioritize First Bank so much, is they will generally give us a clause where there's no prepayment penalty if we sell it. A lot of loans, or most loans, are prepayment penalties or lockouts are just, they're there. Or sometimes there's even a fee, an exit fee on a loan. If a bank will give you an exit fee that doesn't apply if you sell it, that's about the best of both worlds for both sides. because prepayments and those kind of things are one, giving the lenders and the investors the certainty that they're going to get the cash flow out of the loans they make, which is part of why they continue to make those loans, is they know they'll have certainty of getting, 3 years of payments. But all the bank is avoiding is you refinancing to go to somebody else. If rates drop in 6 months and you refinance them out, the bank could lose money on a short duration loan. So if they put an incentive in place saying, leave it with us unless you sell it, they're saying, hey, you're a good partner for us. If somebody shows up and offers you a big number, you've got the flexibility to take it. We would only penalize you if you go refinance it with a different financial institution, which usually just ensures that they stay at the table. So they understand rates are going to drop and rise at different times. And if you're going to lower the rates, they just want to be at the table and have the opportunity to keep the business. That's another, I'll say, very specific example. But we've had it go repeatedly. We've been up millions simply because we've had flexibility. So I will take flexibility and pay 25, maybe even 50 basis points a year for that flexibility all day. Ted, do we have any other? I haven't been able to see the question.
We got the last slide here. We got a couple debt strategy red flags we could kind of talk through and wrap it up. We got about 5 minutes left.
Sweet. Yeah, I can walk you through those. And again, I think we've generally touched on these briefly throughout the presentation. But things to look out for if you're talking to a sponsor about a deal you're considering investing in, if they don't have a clear exit strategy or flexibility in that exit strategy, that's something that should be a concern, because you want to make sure that not only are they planning if things go right, but what happens if things don't go as planned? Do they have, an alternative exit strategy when things go not as planned, or the best case scenario? The unhedged or floating rate on floating rates, essentially that's the interest rate cap policy that Chris was talking about earlier. If you are using floating rate debt, make sure that the sponsor is utilizing an interest rate cap, or that they're very confident in their execution on the exit, in order to make sure that you're not missing anything from a floating rate risk standpoint. Misaligned loan maturity, that's going to be more in line with making sure your business plan execution timelines match the term of the loan, and also making sure that you give yourself a little bit of a buffer on the term of your loan in order to get through any sort of lease up or turnover that's occurring within the rent roll. And so you want to make sure you ask the sponsor, hey, what is our timeline to execute the business plan? And then compare that to the term of the loan and make sure there's a buffer. Leverage with no margin for error, right? That's going to be, okay, hey, at any point in time over our hold period, are we tripping our debt service coverage ratios because we're taking on too much leverage if things don't go as planned? Or, hey, are we taking on so much leverage that if we have to refinance down the line, is that going to be an issue, right? Are we going to be able to successfully execute a refinance, or are we going to be too tight on a refinance because we have too high of leverage and can't meet the current market's debt service coverage ratio requirements or debt yield requirements? And then deferred debt planning, this one should be pretty straightforward. But if the sponsor you're working with is saying, hey, we're just putting this loan on this acquisition to close the deal, and we'll figure out the long-term strategy later, that should be a major red flag, right? Like someone should be planning for the future and not just putting a loan that allows them to acquire an asset, right? Like it's like, hey, this is the amount of equity that I have, so I have to take this loan because it's the only option I have. I'll figure it out later. That's not a strategy or long-term winning strategy.
We did get one last audience question. How much margin for error do you underwrite into your deals from a percentage standpoint?
Yeah, I can jump in there.
Yeah, go for it, Chris.
Yeah, so like on our most recent, like we have an active example of this where we are stressing rents down about 20%, and then also pushing our interest rate up about, well, we actually tier it. When we're looking at a refinance in year 5, we bring the rents down 20, and then we're tiering, okay, today we're getting an interest rate of 6%. What does it look like all the way up to 11% interest rates? And at what point does this break? In this deal, we're in a position where up to 10% interest rates, and at the end of year 5, even with rents pulling back 20% below what we're underwriting today, we will be able to execute a refinance in year 5, right? So it's not like hey, go it doesn't make sense at this point in time. And this is a specific point where we walk away. Like we create a tiered setup where, okay, what happens if rents drop 5%, 10%, 15%, 20%? And then what happens if rates increase 50 basis points, 100 basis points, 150 basis points? And we create, again, another matrix that just allows us to look at it. When does this deal break? And do we feel comfortable with those assumptions at any given on any given deal or any given submarket?
Yeah, Chris, that's a great example, and it probably illustrates how well that that range. A lot of guys, that a stress test is another big word in lending, and guys will say, "Yeah, we stress tested our deal. We looked at rents going down 10%." And it's like, this is the same guy who's underwriting rents going up 5% a year over the next 5 years. Like, that's not a stress test. If your deal works at a 6% rate, great. And when he says, does it work? He's looking at those covenants we spoke about. Like, does our debt coverage ratio still work? And when he's dropping rents over 20%, we actually went to 25 on that particular one. I think we were running $1.55 rents. We spent a lot of time on this deal yesterday, and a 10% interest rate. That's a real stress test. Now, we're not saying we hit the same IRRs we underwrite in that scenario, but we're not losing money. If we're still cash flowing, we can still execute a positive IRR. That's a go versus your no-go decision for us. I think it's highly unlikely we're in a marketplace where banks are charging 10% interest 5 years from now, but I don't know. And conversely, we don't even underwrite the opposite. We don't underwrite, well, what if interest rates are 3%? Because we don't even need to underwrite that. If that's the scenario we're in again, and we can borrow money 3.5%, 4%, that's as good as it gets. That's only upside. And I know this isn't probably the most exciting topic for everybody out there, but I really appreciate everybody taking this hour with us to hear about what goes into debt. Hopefully this has been informative and helpful as you guys look at not only deals with us, but other deals you're looking at to protect your own money, or even in your own real estate lending for your personal assets and, companies, buildings, and things like that. Understanding how this stuff works is critical. We think our banking background is a differentiator. And really, again, a lot of gratitude for everybody showing up today. Thanks.